video, I'm going to teach you how a discounted cash flow valuation works and how you can use it to value a company. It's worth emphasizing that this method of valuation doesn't give you a definitive value, but rather a ballpark figure or a range of values that the company falls in. The idea is to use conservative assumptions when valuing a company using the discounted cash flow method. And then if the stock price is lower than the calculated value using conservative assumptions, then there is a reasonable chance that the stock market price is undervalued. The next step after that is to determine if a stock is undervalued for a very good reason and should be left alone, but that will be dealt with in later videos. To do a discounted cash flow, there are 5 steps, namely 1. Calculate the earnings growth. 2. Calculate the price-earnings ratio, also known as the PE ratio. 3. Determine the terminal value. 4. Calculate the present value of each year's earnings. And finally, 5. Sum up the present values to arrive at a valuation. So let's get to it. To calculate the earnings growth, you need 2 inputs, and those are 1. An earnings per share figure. 2. A growth rate at which you think the company's earnings will grow in the future. To get an earnings per share figure, you could just use last year's earnings per share. However, last year could have been really good or really bad and not really reflect the earnings potential of the company. To overcome this, I averaged the earnings per share figures over the last 5 years to arrive at a figure that represents, on average, how the company might perform in the future. Similarly, we calculate what the average growth rate has been over the last 5 years, and then use this growth rate in our calculation. In practice, it's not as simple as this, as negative growth rates and windfall years need to be taken into account, but we'll stick to the simple case for now. Using these 2 inputs, you can see how the average earnings grow from 3.73 to 4.41 at the end of year 5. To calculate the PE ratio, you need 2 inputs. 1. The earnings per share per year, and 2. The stock price when those earnings were reported. To calculate the PE ratio, you simply divide the stock price by the corresponding earnings per share. We then calculate the average PE over the last 5 years. What a PE ratio tells you is how many years' earnings you're prepared to pay for a company. A high PE of say 15 and higher means that the market expects the company to grow and that the market expects much higher earnings in the future. This also means that any future growth is potentially already in the price, and buying the company now might already be too late. A low PE of say 10 and below means that the market doesn't expect too much growth from the company, and for it to continue doing what it's doing without too many fireworks. And a very low PE of say 5 and below tends to mean that the company is in trouble and investors are scared to own the stock. The terminal value is the value of all future cash flows, assuming steady growth forever. The method I've used is to take the earnings in year 5 and multiply it by the average PE ratio. As discussed earlier, the PE ratio reflects what the market thinks about the company's ability to grow. So over the last 5 years, we are averaging out what the market thinks about how a company can grow, and then using that to multiply by year 5 earnings to arrive at the terminal value. For all those values that we have calculated into the future, we need to work out what they're worth today. A simple example of this is that if you earned 20% interest and had £120 in a year's time, that £120 would be worth £100 today. To calculate the present value, we can use the present value function in Excel, and that function does all the maths for us. The rate that we use to calculate the present value is typically the risk-free rate that we would earn, say if we put the money in the bank to earn interest. This provides a hurdle for the investment. So say you could earn 20% risk-free. £120 in a year's time is only worth £100 today. You're not being compensated for the risk that you take. However, if you can only earn 10% risk-free, that £120 in a year's time is worth £109 today. The extra £9 is what you earn for taking the risk. For the purposes of this calculation, I've just assumed a figure of 2.5%. For the calculations that we are going to do in later videos, we're going to assume that the risk-free return that you would earn from the bank from interest is around 1 or 2%. The final step of the calculation is to sum up the present value of all the cash flows. That's the present value of what's been earned over the 5-year forecast period, plus the present value of the terminal value. All of that gives you the value of the company. All of this forms the basis of how we're going to value companies in the following videos. So, see you in the next video. Cheers.